Hi everybody, I'm David Gully from Bentley University, and this is the fifth of 5 videos on central bank communication. And this particular video looks at the risks of communication and some current issues. So this is the final video in a series of videos, and we have our whole YouTube channel, Bentley University EC391. We have a number of videos on various monetary policy topics. Please take a look at some of those if you have a chance. So what we're going to do in this particular video is talk about some of the reasons why communication from central banks doesn't work out as well as it hopes sometime, and also particular ways in which a central bank can improve its communication to the public at large. So let's talk about some general risks first. So in terms of communicating, a central bank could say too little. So they could not get the message across. That's the bottom line here. They could say very little. They could communicate very infrequently. For example, Jerome Powell could give very few speeches. They might not, for example, give statements after the Open Market Committee meeting that are very helpful. And so they might not communicate what they want to get across to the public. The opposite problem of that, of course, would be they could say too much or they could say it too often. And what happens here, if they communicate too much, that can overwhelm the public at large, and the message gets confused. It gets lost in translation, so to speak. Because remember the old saying, sometimes, in fact, less is more. What they could also do is they could communicate at the wrong level. They could communicate it either at a too high or too low of a level to reach the desired audience. What we'll do here later in the video is talk about how central banks generally aim too high. Not just a little bit too high, but a lot too high. They could also send, inadvertently of course, or accidentally, the wrong message. Central banks unfortunately do this on a regular basis. And so what we'll do here is we'll take advantage of 2 examples provided by the Fed. Ben Bernanke and now the very famous taper tantrum and the blue dot plot. So the taper tantrum of 2013. So at that point, there was some speculation about when the Federal Reserve would end or at least slow down their 3rd round of large-scale asset purchases, known as QE3. So at a June 2013 Open Market Committee press conference, Ben Bernanke suggested that the taper of QE3 might begin near the end of the year. And so financial markets had kind of a panic, in other words, a tantrum, based on the name here. And the Fed's going to end QE, and so what should we do? Well, we should sell everything. And so in the next graph here, we can see what happens is that on that announcement that the Fed might begin tapering is that the yield on the 10-year Treasury rose very dramatically. In other words, bond prices fell. And the US dollar gained a lot of value relative to its foreign counterparts, the euro, the British pound, the Canadian dollar, and the Japanese yen. And we also have the blue dot plot. So this is a mechanism, I got a picture of it here in just a second. It's a mechanism to communicate the interest rate path projections of, and this is important, the individual open market committee participants. And the participants are both the voters and the non-voters in the policymaking process. So each of the participants is asked where they think the federal funds rate will be at the end of the next 3 years, and also what they refer to as longer term. Longer term values are what the participants think the federal funds rate will be when the Fed is hitting its dual mandate. In other words, when it's at full employment and the inflation rate is at 2%. So here's the blue dot plot from June 2019. And so let's just look at the 2019 figures. And so there are, right here, turns out there are 17 individual dots, and each of those dots represents where that particular open market committee participant thinks the federal funds rate will be at the end of 2019. Likewise, at the end of 2020, 2021, and then longer term when the Fed is hitting its dual mandate. And clearly, you could see how this could be construed to be a projected path of the federal funds rate that the committee might be thinking about at the end of 2019, 2020, and 2021, and then longer term, because that's exactly what it looks like. But looks might be deceiving, at least a little bit. Well, so why might this not be the projected policy path? Because after all, couldn't you just take the median for each of those 3 years, and for the longer term for that matter, and say, oh, that's the committee's, and that's the key word, the committee's expected path. Well, here's why you might think otherwise in terms of thinking about the Fed or the dot plot being the predicted path. So here's the first point. So each dot is, I've got this emphasized here, is the particular participant's view of the federal funds rate at a point in time. It is not, in other words, a consensus. So that's one important point. Also, aside from that, two participants might have the exact same economic view of the world, in other words, the exact same future expected inflation rate, GDP growth rate, etc., but they might see two very different federal funds rates that get them to that particular economic outcome. What we can also do is reverse the situation. Two people might have completely different economic outlooks, but they have the exact same federal funds rate that gets them there to those different positions. And then finally, and this is probably the most important one, is that the way the Open Market Committee is structured is that the voters rotate every year, and we don't know which of the blue dots in any particular point in time represent voters and represent non-voters. All those blue dots that we just saw a minute ago, those are all anonymous. We don't know which dot, for example, is Jerome Powell's dot or any other of the participants. They are anonymized. And what's interesting here is that the Fed is they're thinking about getting rid of the blue dot plot or possibly modifying it. And the idea is that it might have outlived its usefulness, and it might be a hindrance in that market participants or the public at large is interpreting this as a projected policy path when it's really not. So in other words, the dot plot might not be sending the message that the Fed wants to send. And more generally, it turns out what the Fed is undertaking right now is a broad review, a top-to-bottom policy review of what's referred to as its policy framework. And what they're doing is looking at everything from their long-run goals, in other words, the dual mandate, all the way down to its day-to-day policy tools. And not surprisingly, part of this review is involving the Fed's overall communication strategy and its sort of on-the-ground tactics. And in fact, the Open Market Committee has a subcommittee on communications, and this is part of the aggregate framework review, and the results are expected in early 2020. So it'll be interesting to see what they come up with. So how can the Fed, or any central bank for that matter, improve its communication? So in previous videos, we've suggested that it might be better that a central bank focus more on data-based communication instead of date-based communication, because time, it turns out, might be an inferior guideline in terms of thinking about policy as opposed to the economic circumstances under which policy might change. Okay, well, what else? So it seems like, and this is true for a lot of central banks, not just the Fed, is that their communication seems to be zeroing in on financial market participants, people who are really interested in economics, and of course, rather obviously, the media. And I'm not claiming that this is a bad idea to aim at these people. To the contrary, it's probably a good idea to aim messages at these folks. Let's think about why this might be the case. So let's suppose the Fed or any central bank announces a policy change. Financial market participants look at this information, they react to it, and when they react to it, stock prices change, interest rates change, foreign exchange rates move, etc. These changes in response, or in turn, affect the public at large. So as a particular example, suppose interest rates change. Well, interest rates are going to affect the incentive of people to undertake mortgages, firms to undertake investment projects, etc. And the key thing here is this is going to be true even if the public at large has no idea about the policy change, they don't understand it, they don't care about it. They still see the result. They still see the resulting change in interest rates. So the question is this enough for the central bank? And the answer is, well, it might be, but more likely it's not sufficient. It's just not enough. So this is some interesting research from Haldane and McMahon. Andy Haldane, he's at the Bank of England. And so this is applying to the Bank of England. So almost 10 years on, despite further rapid growth in central bank communication, it is unclear the general public has benefited from these enhanced communications. So just like the Fed, the Bank of England has dramatically increased the scale and scope of communication, and they're finding that, well, it doesn't seem to have mattered all that much, and that's really too bad. And so what they do is they go ahead and they try to think about how a central bank ought to formulate its communication strategy. And what they come up with is a really interesting idea. They think about it in an epidemiological fashion. In other words, how does, epidemiology is about how diseases spread. How does information spread? How can you get information out to the public at large? And so their general conclusion is that central banks, the narratives should be simple, relevant, and story-based. So their idea is that central banks can do a much, much, much better job of communicating their objectives, their policy changes, their motivations, etc., to the public at large. All right. So what can we do? What specific kinds of things can a central bank do here? Well, one thing it could do is simplify how it communicates. Right? So we've suggested that the central bank is communicating to the media, to economists, to financial market participants, which is fine, but that's not enough. So let's do this. Let's look at just the statements the Fed releases after each and every policy meeting. And let's look at them in terms of their length and their level of writing. And what we're going to get across here is that these are not generally accessible to Joe and to Jane average. So let's first look at the length as measured in words. So over here on the vertical axis, number of words in each policy statement. And we start from 1994 and we go all the way through to right now. And you can see that for a long time, the average length was hanging around 200 to 300 words. But then during the financial crisis, not surprisingly, the Fed had a lot to say, so that statements got much wordier. Well, they probably got too wordy, and so here, this is 2014, Janet Yellen came in and said, look, we need to shorten the statements, we need to make them more concise, and that's exactly what they did. And so the statements shortened dramatically, but they're still, notice, they're still much wordier than they used to be, which is kind of fair because the Fed does have more to communicate than it used to. It has more policy tools. It has, for example, it has large-scale asset purchases, and it has been using communication more, so it's got more to say. But the real problem is not so much the length, but the level at which the statements are written. And what you can do is you can run the language, run the statements through an evaluation tool that evaluates the grade level at which the statements are written. And so there are several of them. The best known one is the Flesch-Kincaid reading grade level. And what this does, this is a formula that grades language or grades a paragraph or a statement on the number of words per sentence and the number of syllables per word. So long sentences and long words count as more difficult, which is pretty intuitive. And the way this is constructed is that on the vertical axis, a 12 corresponds to high school graduate level reading. 16 corresponds to college level reading. 20 corresponds to roughly PhD level. And so notice that throughout its history, at the very least, people have needed a high school education and then some to understand the language in the statements. During the financial crisis, notice that grade level increased dramatically up to, at one point, the PhD level. So policy statements were becoming longer and becoming more complicated. Now, to be fair, certainly policy itself was becoming more complicated, but the language that the Fed was using to describe the policy was just at far too high of a level. It is just simply not accessible to the general public. And so the first problem you've got, of course, is the level of writing, as I mentioned, is too high. The second problem is the concepts used within the writing are extremely complicated. And the important thing here is that Jerome Powell himself has said the most authoritative source of what the Fed is thinking and what they're doing is the policy statement. And if that's not accessible or understandable to the median person in the United States, that's a problem, and that's also the Fed's fault. That's their responsibility. Okay? So in order to improve its communication, it can simplify it, and it needs to appeal to a larger audience. So right now, it seems the Fed is mostly aiming at the policy nerds and the media. And that's not a bad thing, but it's not enough. So what about social media? Well, the Fed, and like lots of central banks, they have a Twitter feed, they've got a Facebook page, and they've got a YouTube channel. But these, it turns out, are really not helpful. So for example, if you look at the Fed's current Twitter feed, all it is links to, for example, open market policy statements or the release of the minutes from the open market committee meetings. They don't contain any helpful things to help the public understand policy. In direct contrast to that, the Bank of Jamaica, the Jamaican central bank, they have very cleverly and very well done music videos to explain aspects of policy. Why, for example, low inflation is good. Why, for example, the Bank of Jamaica has made a policy change. And so these are much more accessible to the public at large compared to the Fed's use of social media. Well, they can, of course, in order to appeal to a larger language or larger audience, use simpler language. So try, for example, these bullet points right here. Now, these are things that I've made up just as for the sake of argument, as in kind of, at the extreme case to illustrate the point. These, by the way, I ran these through the Flesch-Kincaid reading level. They graded out at less than a 1. In other words, at the first grade level. Now, that's maybe an extreme case to illustrate the point, but what you want to get across here is this. Andy Haldane and McMahon, they showed that even people with advanced economics training understood policy statements better when they were written using more simple language. So central banks can do a much, much better job with policy and communicating it if they simplify their language and they simplify the methods by which they get that across. They can also take advantage of visuals. So let's do 2 examples here. So we'll do one from 2017 in the Bank of England when they increased their version of the federal funds rate. And we'll do an example from 2018 when the Reserve Bank of New Zealand decided to hold rates steady. So let's take a look at these visuals. So this is a simple 1-page visual of the Bank of England and their decision to raise their interest rate, their target interest rate, to 0.5%. So up at the top, they said, this is what we did. And then they go right into, well, why did we do this? Well, the pound has fallen, and the falling pound helps push up inflation. Actual inflation is above their 2% target. So notice here they use like a little temperature gauge. They're also saying that the overall economy is pretty good, and more than a million more people in work since 2015. And they're also noticing here at 1.5% that the growth rate is around its sustainable maximum growth rate. In other words, how quickly can the long-run aggregate supply move to the right? And so in big giant font, prices are rising more quickly than our target. Prices are currently rising faster. That's due to the fall in the pound following the Brexit vote. Pound is still much lower than it was a couple of years ago. And then right here, they get to the bottom line. A lower pound means that things we get from abroad cost more, and that means higher prices in the shop. So they're relating it right down to the typical person and how this impacts them. And then finally over here, they visualize the depreciation. They say 100 pounds today buys 20 fewer dollars than it used to and buys 30 fewer euros than it used to. The Reserve Bank of New Zealand, they come up with something even a little more visually simple and a little more visually attractive. So in May 18, they said, okay, we're going to leave our short-term interest rate unchanged at 1.75% in giant bold font. They're also, this is their version of forward guidance. The official interest rate is expected to remain at that level for a considerable period. So notice they're using date-based guidance. So they have some little cartoons here. Global growth continues to support the economy. Employment growth continues to be strong. Low import prices have kept inflation low. Notice this is the exact opposite of the Bank of England example I just did. And then low interest rates will help support employment and raise inflation. They also even talk about risks. We're monitoring a number of risks that are evenly balanced. If any of these risks were to materialize, we may need to change the official cash rate to best ensure inflation hits our target and we contribute to maximum sustainable employment. So compare this to, for example, the single dense 1-page policy statement from the US Fed. This is much more straightforward, much simpler, much more relatable to the general public. One more additional piece of information here in terms of maybe the Fed isn't getting its message across. Just this year, a very interesting study surveyed 20,000 people in the US and asked them a number of questions, but one of the questions was, what's the Federal Reserve's inflation target? And remember, this is a survey of 20,000 people, representative sample of the population at large. What's the Fed's inflation target? The correct answer, of course, is 2%. Well, where is 2% in the bar chart here? So let's give the benefit of the doubt. Let's suppose that anybody who answered between 1 and 3%, in other words, was a percentage point off, got it right. Notice that the vast majority of these 20,000 representative people don't know what the Fed's inflation target is. And what's most astonishing is that very nearly 40% of them thought the Fed's inflation target was 5 times what it actually is. That suggests very strongly maybe the Fed isn't getting its message across, even at the most basic level of its central inflation target. And so what we're getting across here is this. We shouldn't think along the lines of Alan Greenspan, who was chair of the Fed several chairs ago. This is a very famous quote attributed to him. "Since I become a central banker, I've learned to mumble with great incoherence. If I seem unduly clear to you, you must have misunderstood what I said." That is no longer the model, or should be the model, of central banking. So in summary here, what we want to get across is communicating policy is really very difficult. And unfortunately, there are lots and lots of examples, not just from the Federal Reserve, but of central bank communications that haven't gone very well. And what's been happening, in effect, is central banks, unfortunately, don't really have kind of a master plan in terms of how they're communicating. What they're really doing is a lot of learning by doing. And of course, when you do that, you make a lot of mistakes. But even still, a lot of central banks are working to try to improve how they communicate to the public. And the way they're doing this is they're generally simplifying their communication, and they're using more visuals. And the reason this is important, because this is the bottom line, what they're trying to do is improve policy outcomes. They're trying to help themselves achieve their policy objectives, and they're trying to improve the trust and the credibility in central banking. Thank you very much.